It's equally clear that this is a thriving, entrepreneurial, and dynamic economy.
We want to be the first Europe-based among the global Tier 1 CIBs with an international reach.
We are optimistic about growth. I mean, we're very aware of the challenges that our people are facing.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in for Francine Lacqua in London. Here is what's coming up in today's programme. Technically speaking, the US shrinks for the second straight quarter as raging inflation undercuts consumer spending. But Janet Yellen insists the country is not in a recession. Prime time. Amazon surges post-market after giving a bullish revenue forecast and posting sales that beat estimates. Apple also climbs on the back of iPhone demand. Plus, banking on IT. Standard Chartered, NatWest and BNP cheer investors as earnings beat the street. Shares in the lenders surge. Welcome to the programme, everybody. This is Bloomberg Surveillance Early Edition. Let us get to some of the data that we have coming out of the Eurozone right now, and we'll get to the Italian GDP figure. The preliminary second quarter GDP number rising by 1% quarter on quarter. That is against an estimate of an increase of 0.3%. So that number coming in well above estimates, and that really picks up on a trend. That's what we've seen coming through so far from France and especially from Spain. The message is that the economies have been running more strongly than had been expected, but big questions, of course, remain ahead. Tourism acting as a boost, it seems, in the short term. We've also had inflation data hitting this morning, and we've seen record inflation coming through in France and in Spain. Let us go to Germany then. We've got German GDP numbers coming through as well. Germany preliminary second quarter GDP unchanged quarter on quarter. The estimate was for an increase of 0.1%. So a different story coming out of Germany. Elsewhere in Europe, we're seeing these economies kicking at a stronger pace than we had anticipated. So beating estimates. So we saw that out of France, out of Spain and Italy. But in Germany, we see no growth, unchanged quarter on quarter for the GDP number for the second quarter. The estimate was for just an eking out of 0.1%. So let's not make too much of a slight miss, but it is showing a demonstrably different message, I suppose, to the other parts of Europe, at least versus estimates. So that's what we have on the growth story right now. Let's get to the broader markets and where we are on the broader market narrative right now. Stocks in Europe doing pretty well, actually. Is this all about expectations around the Fed? Are they well placed? Are they misplaced? A conversation we will no doubt have as we go through this morning. We do see the Nasdaq futures pretty strong this morning, up by 1.3%. And I mentioned that we had some strength in the Amazon story, certainly strength there. That stock up by 13% after hours. And we also have strength in Apple as well. So that's pushing up Nasdaq futures. Euro is up by 0.4%. So some of those data beats, you know, maybe that's part of it. But also we're seeing generally in a risk-on environment, weakness in the dollar, and that's pushing money into the euro and into the pound. Brent crude is up by 1.7%, 108 now the handle. We had been talking about how oil prices had retreated so much from recent highs, and now they seem to be creeping up again day after day. We are working our way towards an OPEC meeting that takes place tomorrow. Let us just give you a little summary of where we are across Europe on the Europe map. We have strength then coming through on the European equities, up by 0.8% this morning. There's the earnings story. I said banking on IT in the headlines. I meant to say banking on it, of course, just to correct myself, because some of the bank earnings have been pretty strong. We'll come to those in just a moment. But this is what we have on European markets. Right now, we see that the CAC 40 is up by 1.4% and the IBEX and the FTSE MIB doing pretty strongly this morning as well. On to some movers. Let's get to some of those detailed stories, including one of the banking names. These are the ones that are moving higher for you this morning. So let's go to Hermes first. This is the luxury maker of watches and clothes and leather goods in France. Second quarter sales beating estimates, demand for watches and clothing. So after we heard from LVMH and Kering and other luxury names, Hermes seems to be picking up that baton and running with it in style. NatWest is up by 7.3% this morning, better than estimated numbers coming through there. An impairment release instead of an expected charge, and also a special dividend from that British bank. And Renault up by 6%. Yes, the numbers, if you look back, look disappointing. They had to take a big hit on their Russia business and pulling out of Russia, but they are guiding higher on the rest of the company. Let's move to the downside. So stocks that are losing ground today, and AstraZeneca in focus, the drugs maker here in Europe. And actually, This is the only sector, one of the few sectors in Europe that is in negative territory today. So EPS came in above estimates. They've actually increased their revenue guidance, but some analysts sceptical, saying it was one-offs that fueled the beat in the first place. We've got Vivendi down by 4.6%. The profit missing there, a cautious outlook according to some analysts, and Prosus down by 4%. If there was an area of weakness through the Asia session, it was around Chinese technology shares, and with that as the narrative, that weighs on Prosus, which has, of course, exposure to Chinese tech. Now, meanwhile, let us get back to the big macro picture. The US economy contracted in the second quarter as inflation undercut consumer spending and Fed rate hikes stymied business investment and housing demand. Meanwhile, Janet Yellen shrugged off recession talk, saying a true recession is a broad-based weakening of the economy.
We do see significant slowdown in growth. That's to be expected given how rapidly the economy grew when it was recovering from the pandemic and all of those job losses, and policy was designed to do that. We should expect to see a slowdown. This economy is at full employment.
Let's get analysis now with Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity International, who's with us this morning. Salman, very nice to have you with us. Let's take a moment to think about where we are on the global growth story. We'll start with the United States then. Janet Yellen talking there about what a recession is in her mind. Of course, the US in this interesting position where they have a body that officially decides whether they are in a recession or not. You have to wait a long time for that. So what is your view as we wait for them to decide?
Good morning. So our view is that there is a significant slowdown, but a contraction in GDP, which basically has a meaningful impact on markets, will lead consumption to come under pressure. So there is a slowdown in personal consumption expenditures from Q1 to Q2. And that's probably the main story which we read out of those two estimates which have come out of the Q1, which was negative first, and then another Q2 which posted negative. But that's the thing we have to keep in mind because that if the consumption slowdown continues, and that will feed into the labor market, that will feed into a broad-based contraction, which basically will categorize as hard landing. But there's no doubt that the U.S. economy is slowing down right now.
Slowing down, but do you think there's no doubt we get a hard landing as well, Salman?
So our actually base case is that we will get a hard landing in the US in the next few months, and our soft data trackers are consistent with those numbers. But I would say that Q1, Q2 data is not consistent with the hard landing. We would need much more damage, especially as I mentioned on the consumption side, but also a meaningful increase and a visible increase in unemployment rate, and that would to our minds would be noted as a hard landing.
Okay, and do you see any signs of weakness in the labour market as yet? I mean, what's the if we think about the time horizons involved here, when do you think we're going to see substantial weakening in the labour market? We've heard anecdotal evidence from certain companies that they are either freezing hiring or looking to get rid of people, but labour markets are so tight.
There is no doubt, and the labor markets are very, very tight right now, but there is a delta change happening. We are picking up through our trackers that some of the pressure is coming down, but it's not consistent so far with the weakness in soft data. So it's the soft data, especially, for example, the business surveys, their components, and especially the future activity components are the ones which are flashing properly red. And based on historical calibrations of the 7-8 recessions we have done between the soft data and hard data, the lead lag can be up to a quarter. So this Q3, Q4 is the critical stage where we think that there should be a visible increase on the pressure on the labor market, because that's the last bit, a big bit, which is still showing very strong resilience despite the fact that we have too much tightening.
We've had some unexpected strength, I suppose, at least in the short term, in the Eurozone growth story this morning. We'll wait for the full Eurozone picture in 50 minutes' time, Salman. But in the run-up to that, we had France beating estimates, Spain beating estimates, Italy really beating estimates, Germany, though, looking very different and looking very stagnant at this point. Of course, the questions, though, are ahead. They're about the winter. When do you think we learn the extent of the weakness in the European story?
So on that front, I think the signs are already there. So the fact that Germany underperformed the rest of Eurozone countries is because of its higher dependence on gas flows from Russia. Obviously, that disruption has increased further, has become much more is in a much worse state. and then the rationing plans, which are now starting to come through, we think that they will get accelerated. The calibration we have done is that if gas is completely shut down or stays at the current very low levels from Russia, you're talking about a 5 percentage point shock to GDP for Germany. So this is just the start of the story. And Germany would be the one which will face most of the pressure because of its dependency. The spillover effect on other countries will come through in Q3, Q4.
Okay, thanks so much, Salman. Thank you for joining us. Salman Ahmed, in fact, he stays with us. We'll have more from Salman in a moment. Global Head of Macro and Strategic Asset Allocation at Fidelity International. Let's have a quick look at where we are on the pre-market on Amazon and Apple. We know that Amazon rallied really strongly after hours, so no surprise to see in pre-market that we are up by 12.4% on the Amazon share price. Apple also delighting to some degree investors, and that stock up in pre-market, up by 2.8%. So Nasdaq futures are up by 1.4% as we reflect on all that we've learned about the tech sector this week. Coming up, we continue the markets conversation. We'll get back to the earnings stories. We'll put questions around earnings to Salman. That's coming up next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards, in for Francine Lacqua in London. We're wrapping up an intense week of earnings. We're now seeing inflation is hitting consumer demand, with Diageo and Unilever trying to keep their prices as low as possible. In comparison, luxury goods remain in high demand.
We certainly are seeing continued inflationary pressures on our cost of goods.
What we try to do is offer a good, better, best assortment in our portfolio, so people who need a more value offering can find it in the Unilever portfolio.
We're not sensitive to where people spend or what they spend on. We're only sensitive to how much they spend in total.
So far, we have not seen any reduction in demand for Mercedes. So demand for us currently is strong.
Big brands gained market share versus private label during COVID, and in some categories in some countries, we are seeing a strengthening of private label market shares.
A business like ours, we have multiple levers that help us to handle the inflation. We are very surgical and careful on how much pricing we take and where.
Let's get back to Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity International. Salman, so we've heard a lot on the earnings front this week. There's been a lot to digest, pricing power, buybacks. We've had all kinds of different themes going on here. Broadly, you are underweight equities. Has that view been reasserted? Have you been reassured in your view there by the earnings season so far?
So the earnings season for Q2 has been a bit more of a mixed bag. There are clear-cut signs of weaknesses in some of the sectors which we are interested in, especially which are related to the consumer side of things. But there has been, for example, the beat from Amazon and Apple. There are some signs that the economy is probably not slowing down as much as we thought. There are also some signs of, very importantly, supply side issues starting to get better. And I think Apple was an interesting story on that front, where the supply chain, the cost pressures coming from the supply bottlenecks are reducing. So we have to take those into account. But we remain of the view that the most of the damage to economic activity is a Q3 story, not a Q2 story. And there is a little bit of a real view mirror dynamics going on in the earnings profiles right now.
Okay, so you think there's still damage to come then, Salman? So how do you think estimates then will need to be downgraded into the next earnings season?
Our Fidelity analysts are below consensus, and we do think that further earning revisions will be on the negative side. And that's if you look at, for example, consumer confidence data, which is at all-time low, the housing market affordability, which has collapsed in the US, of course, the gas disruption ongoing in Europe. We do think that obviously the corporate sector earnings will be exposed to all these forces, and the risk is towards negative earning revisions going forward.
You say you prefer emerging markets when it comes to equity, Salman. Why is that? Because some might be struggling with dollar-denominated debt or for other reasons. Tell me a little about what's driving that emerging markets call.
It's mainly China. So China economic cycle has been completely delinked and decoupled from the rest of the world because of COVID policies. And of course, the valuation stress they experienced as a result of that was quite extreme. So as zero COVID policy becomes much more dynamic, the application becomes a bit more liberal. The bounce back in growth, we think, will be strong, and that should help some of the valuation stresses we saw in some parts of the market. And that should spill over with some of the EM countries, but we'll have to be very selective here for sure.
Do you see signs of that more liberal policy in China?
We are seeing, for example, our onshore analysts are reporting that testing, for example, has become much more targeted. We are also seeing, obviously, signs of vaccination pick up in a big way. What is actually in the last recent couple of weeks, what we have become a bit more concerned about is the mortgage delinquencies and the boycotts rather than COVID per se, whereby the pressure on the property market may come again. That's what we are focused on right now, rather than being concerned about reapplication of a stringent ZCB policy.
This month has been a strong month for stocks and for bonds, Salman. The best. In fact, you have to go back to the end of 2020 to find a better one when it comes to global stocks and global bonds. Does that make sense to you? Do you think some of that, back to where we started the conversation, really, I suppose, do you think some of that faith in a pivot from the Fed, if that's what's been driving this positivity, do you think that's well-founded or misplaced?
We are very skeptical about this kind of relief rally, given that most of the damage lies ahead. And if you look at the Fed statement and the communication coming from Chair Powell, you can read it anyways because it was very flexible, open-ended. If the data is for example, inflation data surprises again, we are looking at another 75 basis point. So there's a lot of hope there, and I can understand why, because we fell in terms of drawdown quite sharply, but most of the damage is ahead of us, not behind of us, and that worries us.
Okay, and what about global bonds and government debt? Salman in particular, some people are talking about how a lot is uncertain really about how the bond market will perform, yes, during a time of recession, which might drive demand for the perceived haven, but also at a time of high inflation, not like recessions that we have known most recently.
So we are long global bonds, i.e. duration risk. And the reason behind that was that because of the rising fears of recession. And to your point, this is a very different cycle in that regard, that inflation is much higher, the starting point is much higher, and it may settle at a higher level than we have been used to. Then that means that nominal levels of bond yields have to be recalibrated. But the delta, the direction of pressure for us is still that, that bond yields can compress a little bit more from here as recession becomes more clearer, and the Fed will have to stop the hiking and in fact we may have to start thinking about cuts going forward, but we are not there yet. And in this regard, we like bonds versus equities.
Okay, Salman, thanks so much for your time. Good to speak to you. Have a good weekend when we get there. Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity International. Coming up later in this programme, we'll get back to the earnings story. L'Oreal sales climb as demand for makeup bounces back. We will speak to the CEO of L'Oreal, Nicolas Hieronimus, will be joining us at, in fact, just coming up a little bit later on, 9:40 London time. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London. Let's get a Bloomberg First Word News update with all the top stories we're covering this morning. Here's Leanne Gerrans. Good morning, Leanne.
Good morning, Anna. US President Joe Biden and his Chinese counterpart Xi Jinping are planning an in-person meeting after a call yesterday. Tensions are rising over Taiwan, with a possible visit by House Speaker Nancy Pelosi complicating relations. If that meeting happens, it would be the first face-to-face meeting between the two since Biden became president. Now, the drumbeat of recession in the US is growing louder. The economy shrank for a second straight quarter as inflation takes a bite out of consumer spending. Well, that may define a recession in many other countries. The US waits for an expert panel to decide before declaring a recession, and Treasury Secretary Janet Yellen is giving a positive take on yesterday's data.
We do see significant slowdown in growth. That's to be expected given how rapidly the economy grew when it was recovering from the pandemic and all of those job losses, and policy was designed to do that, we should expect to see a slowdown. This economy is at full employment.
There is a risk of recession in Europe. That is the take of ECB Governing Council member and Bank of Italy's governor, Ignazio Visco. He says the central bank's decision to hike rates by 50 basis points gives them room to make data-dependent choices at future meetings.
There is a risk of a recession in Europe in all our assessment, mostly linked to the developments of the war. And if at the end there is a cut in supply of gas from Russia, these may have clearly substantial negative effects.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Leanne, thanks so much. We'll get back to the tech sector. NASDAQ futures point higher. We'll get analysis next. This is Bloomberg. Technically speaking, the US shrinks for the second straight quarter as raging inflation undercuts consumer spending. But Janet Yellen insists the country is not in a recession. Prime time. Big tech stocks open higher in pre-market trading after Amazon and Apple's resilient results. Plus, banking on it. Standard Chartered, NatWest and BNP cheer investors as earnings beat the street. Shares in the lenders rise. Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in for Francine Lacqua today in London. It has been a busy morning for European bank earnings, many offering positive outlooks as well as beating estimates. We spoke to Standard Chartered CEO Bill Winters, NatWest CEO Alison Rose and BNP Paribas Lars Machenil.
I think the inflation problem we've got is quite substantial and reasonably intractable. So I think the Fed's going to have to hit pretty hard. So I guess that means a terminal rate at 3.5 or maybe even 3 3/4 or 4%. Is that what it takes to tip the U.S. into recession? Yeah, I think so. Speaking candidly, but we hope for the best. And I think Europe obviously has the incremental burden of energy prices, and that's tough.
Deposits still remain very strong. What we're seeing is households have a buffer in terms of the cash deposits, and there is still a huge amount of liquidity sitting on corporate and business balance sheets. What we're seeing at the moment in terms of debit and credit card spending for our customers is actually, although there are increases clearly, particularly in fuel and energy prices, the real increase in spending at the moment is on travel and hospitality.
The growth will not be the growth that we would have thought 6 months ago. Yeah? So that environment will be different. But how exactly will it be? Will it be a slowing down? Will it be a technical recession? So basically gravitating towards zero? What will it be? Listen, as I mentioned, I don't have a crystal ball. The thing that has to be there as a bank, we have to be there to help our clients in all of these circumstances.
Thoughts from the banking sector. Let's get analysis now. Bloomberg's Tom Metcalf joins us here on set in London with thoughts on what we've heard so far. Tom, good morning to you. We've heard so much from the earnings season this week. What has stood out for you?
Well, certainly the bank that stands out is Credit Suisse. We can dive into that in a bit more detail, just in terms of individually what a mess it continues to be. But I think it's kind of going across a whole sort of real variety of European banks. One is it's a pretty positive outlook in terms of provisioning. So NatWest today, for example, they actually released impairments, which is really quite extraordinary.
Yeah, they'd been an expected charge, hadn't there?
Exactly. So a complete, a reversal. And that really suggests they're still seeing very little defaults. They're pretty confident. And that seems to be the message, is everyone's saying, oh, this is quite benign. And then you contrast that with some, slightly pessimistic comments and some pretty pessimistic economic data. So I think maybe for me, the thing is there's almost a time lag. They haven't seen any kind of hit yet on defaults while they're benefiting from these net interest income.
Yeah, so is that the message that we take away on the UK economy, that, well, the banks have not been hit yet by any expected slowdown?
Yeah, I would expect as quarters go forward, you'd see a bit more negativity and perhaps, more impairments. But right now, pretty much across the board, Barclays, Lloyds, NatWest are all pretty positive.
And I suppose Credit Suisse was always going to stand out because of the management change and because of the issues with their performance. And they stand out even more so when the competition is doing pretty well.
Yeah, exactly. I mean, it was, I think, come on before and said, well, I think the thing they were really aiming for this quarter was sort of a clean, quiet quarter, obviously big restructure in there. And that's the thing, we took a look at their investment bank, and while the US banks, a lot of the European banks have seen really strong trading quarters, at Credit Suisse, for various reasons, it was absolutely tanking.
OK, do we have more banks to report next week? What are we looking ahead to in the world of financials?
The one I'm really looking forward to is HSBC on Monday, and that is obviously a bit of a bellwether for the UK and also Asia, but it's particularly interesting at the moment. Obviously, there's this Ping An sort of pressure to maybe break up the bank, and then on the Tuesday after their results on Monday, they're actually meeting with their Hong Kong retail investors. So maybe we'll see some progress around that whole issue. OK, interesting one to watch then, Tom. Thank you very much. Bloomberg's Tom Metcalf with the latest on the banking sector. Let's go from banks to tech earnings. Major US technology and internet stocks have opened higher in pre-market trading after Amazon and Apple both issued resilient results in a difficult economic backdrop. Let us speak now to Matt Bloxham from Bloomberg Intelligence. Matt, good to speak to you once again. I feel I've spoken to you every day. That might be true. We've had so much to talk about on the tech front, haven't we? Let's start with Amazon then, because this is the big mover, isn't it? Both in pre-market, well, after hours and now in pre-market. What was so good at Amazon?
I think the most important thing was what they said on costs. That's been the big worry for the last 2 or 3 quarters, because they invested so much in warehouse and staff to kind of through the pandemic. That caught up with them on margins, and a very clear message that in the quarter that's under control, and that it's going to be an incremental focus going forward, particularly in terms of headcount. I think interesting, they said they're going to shift their spending towards the cloud business. So that tells you where they think the growth opportunity is, certainly in the near term.
And you've always talked about that as being a profitable part of the business.
Yes,
that's what's driving profits.
Absolutely. It dwarfs everything. I mean, the e-commerce side is still loss-making, as all of the profit really is coming from the web services business right now.
That's amazing, isn't it? In terms of the outlook for the US economy, did we get any clues here? Because clearly after Walmart, everyone was nervous about what the US consumer is doing. But Amazon is a global business. Did they shed any light on the consumer?
Not much, but I guess it was a sense of optimism. Perhaps a little bit like Tom said, a lot of these companies are not seeing the slowdown yet, and they'll only talk about it when they see it. But they were certainly confident that they're not seeing a slowdown in spending from their customers, and they're confident that they'll continue to spend on the Amazon platform going forward.
And what about Apple then? Let's move over to Apple. So this one also called up pre-market, seen trading higher. iPhone sales, so back to the bread and butter of Apple, really. Exactly,
yeah. So the iPhone sales were slightly better than people were expecting. Still a bit weaker than historic trend, but just north of $40 billion in the quarter. People were looking for 39 billion and change. And again, confidence from them that with the product refresh that we normally get in September, that it's going to continue to see strong demand and potentially some light at the end of the tunnel on supply chain issues.
So I was going to ask, are they seeing that? Because there are some sectors that still seem to be plagued by those supply chain issues. Certainly, we talked to car companies, and also some medical technology like Philips, still talking about supply chain issues.
Yeah. Again, very mixed messages, I think, this quarter from different companies about what's going on with particularly chip supply. I think the message from Apple is that it's still a problem, but they're working their way through it, and they can see it becoming less of an issue for them through the second half of the year. OK, Matt, thanks so much. Thanks for joining us. Matt Bloxham, our tech analyst with Bloomberg Intelligence. Lots to discuss then when it comes to the earnings stories. Let's bring you up to date with some of those and get a Bloomberg Business Flash. Here's Leanne Gerrans.
Hi, Anna. Citigroup is requiring some of its least profitable trading clients to post more collateral and is even dropping some of them to help boost returns in its markets business. The moves have helped the unit make progress on its efforts to improve its ratio of revenue to risk-weighted assets, a key focus for the bank. Now, Comcast saw its biggest drop in more than 13 years yesterday. That is after its prized internet business added no new customers last quarter. It's an absence of growth not seen in decades and is due to a housing slowdown and also heavy competition. Analysts expected around 83,000 new subscribers for the quarter. However, none of them predicted the gain would, in fact, be zero. And pharma giant AstraZeneca has raised its outlook for 2022. That's after second quarter revenue and earnings per share beat expectations. The results were fueled by growth in all disease areas, including treatments for COVID-19. Sales jumped 48% in the first half of the year. And that's your Bloomberg Business Flash. Anna.
Leanne, thanks very much. Leanne Gerin's there with a business flash. Coming up on the programme, back to earnings and L'Oreal sales climb as demand for makeup bounces back. We talk earnings with the CEO, Nicolas Hieronimus. He's with us next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London. Let's get some more on the earnings news now. L'Oreal sales climbed as demand for makeup bounced back and the strength of its luxury products offset the negative impact of COVID-19 restrictions in China. We're joined now by the CEO of L'Oreal, Nicolas Hieronimus. Very nice to see you, Nicolas. Thank you for coming to talk to us. So strength in these numbers, and the market is rewarding that. The stock up by 2.9% right now. You've been pivoting further towards the luxury end in recent years. How much do you think that is helping you at this point?
Well, I think overall, rather than pivoting to one end, what I highlighted in my comments about this half's great results is the balance of the performance of L'Oreal between divisions and regions. You're right to say that luxury has been driving a lot of the growth of L'Oreal for years, and it has become a number one division. But I'm happy to say that our consumer products division has really accelerated with +9 on Q2 and is driving our growth in the emerging markets. So today we have a very balanced growth between Chinese consumers, America, Europe, and emerging markets, and that's really helping us being both agile and that's very useful in this very VUCA environment.
Yeah, Nicolas, what is your experience with different types of consumers at different price points? Because across the consumer-facing sectors, we've heard very strong stories coming through from luxury names and slightly more measured stories, maybe challenged stories coming through from lower-end consumer-facing products. What are you seeing in your consumers? What's the story you tell?
Well, what I'm seeing is that consumers, after 2 years of pandemic, want to indulge themselves with high-quality products and pleasure products, and beauty is part of these affordable pleasure products. But what's very important, and it's across all price points, is that people want high quality. That's why the market is premiumizing, and of course, luxury provides this high quality products at a high price. But if I look again at our other divisions, whether it's our mass market with skincare serums or great hair care products with hyaluronic acid, or our active cosmetics brands with a brand like CeraVe or La Roche-Posay with ultra effective sun filters, in all instances, people are actually, even when they're counting their dollars, they want to buy the best quality. And this quest for the best quality is what drives the L'Oreal performance.
So if consumers are premiumizing, Nicolas, to use your word, are you seeing no evidence of consumers trading down to cheaper options?
Absolutely not. We are, of course, very aware of the uncertainties ahead, and we are, preparing for everything. And that's why, by the way, it's such a great thing for us to be a pure player in beauty and have a price piano, if I may use that term, that starts from shampoo at $3 to creams at $300, so we can satisfy everybody. But really, today, we do not see consumers trading down. On the contrary, as I tell you, they are investing in quality, and our best products and our best brands are the ones that have the fastest growth.
There's a debate about whether the US economy is or isn't in recession. A lot of people saying no because unemployment's still low. Here in Europe broadly, and in particular in the Eurozone, there's a debate about whether we'll see a recession in the Eurozone through the winter. Are you preparing for tougher times ahead, Nicolas?
Yeah, we are preparing for tougher times, and at the same time, we remain optimistic and bullish. We are preparing because we have to prepare for any event, and we've proven at L'Oreal during the COVID-19 crisis that we could outperform the market, protect our profitability, and that we continued, even though stores were closed at the time, to invest in launching new products. So we are preparing for what's ahead, and we have new innovations. We have monies to spend in advertising to seduce consumers, But at the same time, we remain optimistic because beauty has proven across history its incredible resilience, particularly in times of trouble. By the way, we have, you've probably heard of this famous lipstick index theory, which whereby women and maybe men in the future are using more lipsticks when times are tough. And right now we see this appetite for indulgence. So we don't know what's ahead. And I said we are prepared for it. If there's any downturn, we'll be able to cope with it, but we'll remain bullish and optimistic, and we want to bring out new great products to consumers.
Nicholas, what do you see on the supply side? Are you having difficulties with supply chains at all? Some businesses, some industries are still facing that post the COVID challenge.
Yeah, of course. We are not immune to the global tensions. There are, of course, differences between parts of the world and categories. We have more difficulties in the USA, for example, than we have in Asia. And some of our skincare, our very successful skincare products have been facing shortages and insufficient service levels. We also see tension on the fragrance category because this category is booming, and we are at plus 35% after 6 months on the same type of growth last year. So there are some shortages, but I would say we manage overall, thanks to our global clout, our negotiating power, and the agility of our operations team to weather through these difficulties and still manage to deliver some good results.
Can I ask about China? You mentioned that one of the strengths of the business is its geographical spread, Nicholas. But in China, of course, a number of businesses still facing issues created by intermittent lockdowns. How is that playing out for L'Oréal right now?
Well, I think that's probably the performance I'm most proud of, because I kept on hearing questions about how terrible was the situation in China with the lockdowns. And it's true, it was difficult, and the market was negative in April, May in China, and bounced back a little bit in June with the end of the lockdowns. But we did a fantastic performance in China. We grew by 8% in Q2, and if I take the overall Chinese consumption, so Chinese buy in China and maybe in some travel retail areas, we grew double digit, and that's thanks to, of course, the agility of our team, the strength of our brands, which are loved by Chinese consumers, but also it's linked to our extreme strength in e-commerce. Over 60% of our business in China is done in e-commerce, and we master that game pretty well. And when stores are closed, people can still order online, and that's allowed us to grow, to lead the famous 618 festival, which is a big shopping festival in China. And I'm still very ambitious for our business there, because we've only scratched the surface. We serve 100 million consumers in China when there are 400 million that could afford our products. So we still have some work to do. Great teams there and great brands.
Nicholas, thanks so much for your time. We appreciate it. Thanks for coming to talk to us. Nicholas Hieronimus, the CEO of L'Oréal. Coming up on the programme, we'll get back to geopolitics. US President Joe Biden and his Chinese counterpart Xi Jinping plan for an in-person meeting as tensions continue over Taiwan. More on that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards, in for Francine Lacqua in London this hour. Let's get back to geopolitics. US President Joe Biden and Chinese President Xi Jinping told aides to plan an in-person meeting during a phone call yesterday. That's according to a US official. It comes as both leaders stake out their positions in a simmering dispute over Taiwan. Joining us now is Bloomberg News' Bruce Einhorn. Bruce, nice to speak to you. So what came out of this phone call?
Well, Anna, it's interesting, the point about the visit or the upcoming meeting between the two presidents in person. That's something that a U.S. official said the two presidents discussed. The Chinese notably did not mention that in their readout of the meeting. This is the fifth time that the two presidents have had this kind of a call over the phone, or they still haven't met in person. They spoke for about 2 hours, 20 minutes. We know that they went over positions regarding Taiwan, no new ground there, just both sides reiterating their existing policies about Taiwan. According to the US, President Biden did not bring up with President Xi anything about tariffs. There's a lot of discussion now about whether President Biden is going to ease some of those tariffs that are still in place from the trade war under the Trump administration. There's still a decision likely to come sometime soon on that, but in this call, it's not something that the two presidents discussed. There was a lot of talk about Taiwan, though.
Yes, absolutely. So on that subject, what will happen if House Speaker Nancy Pelosi does go to Taiwan?
Well, we don't know if she's going or not. Let's be clear. She has a trip scheduled for Asia in August. There are several places on her itinerary, on her official itinerary. Taiwan at the moment is not, and her office has not confirmed whether or not she is going to go. President Biden did say last week that the military, US military, doesn't think that a trip right now would be a good idea. China, of course, considers any visits to Taiwan by officials of that stature to be violations of the One China policy. It's worth noting that this would not be the first visit by a US speaker to Taiwan. Newt Gingrich, who was Speaker of the House back in the late 90s, did make a trip there. So there is precedent for this. That said, these are very different times. US-China relations are much worse than they ever were back then. So the equation is quite different this time, Anna.
Yeah, Bruce, thanks very much for the update. Bloomberg's Bruce Einhorn with the latest on relations between China and the United States. Let's stick with geopolitics. We're currently getting pictures coming through from a press conference being given by the Russian Foreign Minister, Sergei Lavrov. You see him speaking there. These pictures coming to us from Tashkent in Uzbekistan. He's speaking at the Shanghai Cooperation Organization. He says he's agreeing a time for a call with Anthony Blinken, of the United States, of course. He's also saying he'll listen to prison swap proposals. So we'll see if anything comes of that. But we are getting these live images coming to us from, as I say, Uzbekistan. From geopolitics back to the markets, and European stocks have been doing pretty well today, mostly on the back of the earnings story. We see a lot of positive reaction to earnings, but also broadly around the earnings tech story coming out of the United States. So the Stock 600 up by 0.8%, the FTSE up by 0.6, the CAC are doing pretty well today, the IBEX and the FTSE MIB also. So we are seeing strength across Europe. The Nasdaq futures picture representing or indicating the optimism around those Amazon numbers and Apple, both of those after hours, provided some reassurance perhaps to a nervous tech investor. And the euro is at 102.19, up 0.2%, but actually maybe it's more dollar weakness. This is a risk-on day then for global assets, and that tends to weigh on the dollar, and we see money going into the euro. I was going to say also into the pound, but that's turned around. Not so anymore. The pound just edges a little lower. And we're waiting for an OPEC meeting next week, so the Brent price of interest as it keeps edging upwards. Quick word on some of the movers. We've seen some strength coming through in earnings from Hermes, from NatWest, and Renault. All of those stocks are moving substantially higher on the back of numbers coming through there. And to the downside, though, AstraZeneca apparently relying on one-offs, according to the one analyst at least. So that's weighing on their business, despite the fact they guided higher on revenue. Vivendi also under pressure, as is Process, given their connections with Chinese tech. That is it for Bloomberg Surveillance Early Edition this hour. The programme continues. Kailey Leinz and Matt Miller will join me from New York. This is Bloomberg.
What we're seeing is what you would expect. Financial conditions tightening, the economy slowing down.
This economy has materially slowed down. We are not in the roaring 20s. We are not in the reflation trade.
Our concerning still leave us with more of a bearish tilt.
I think ultimately what's going to drive things like rates or FX is the relative growth concepts.
The dollar could remain firm despite the issues of the U.S. economy.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Traders focus on recession instead of inflation. That's led global bonds to their biggest monthly gain since 2020. Today, investors are waiting for data on the Fed's preferred inflation gauge. We get PCE deflator, U.S. personal income, and consumer sentiment. Big tech comes to the rescue. Amazon and Apple surprise Wall Street with quarterly sales results. And Joe Biden and Xi Jinping now plan to meet in person. But the question of whether House Speaker Nancy Pelosi will visit Taiwan could complicate matters. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London, Matt Miller and Kailey Leinz in New York. And Kailey, we've got real strength of sentiment here in European equity markets driven by European corporates, some data also out here in Europe, but also the tech themes coming through from the US.
Yeah, and that's definitely lifting U.S. futures as well. But what's noteworthy, Anna, is Asia really sat out those gains. The MSCI Asia Pacific Index as a whole literally flat on the day, but the real underperformance came from big Chinese technology stocks. The Hang Seng Tech Index down almost 5 full percentage points, and that was in large part due to Alibaba. Those shares were down more than 6% on reports that Jack Ma will be ceding control of the fintech arm Ant Group. Of course, the regulatory overhang still very much front and center, as is the fact that we didn't have any more stimulus promises from the Politburo out yesterday, so that really damped down sentiment in the entire region. And of course, we've seen a massive rally in the bond market. That was true in treasuries yesterday. You saw Australia following that move with the 5-year yield down almost 19 basis points. And the action in foreign exchange, really, to me, the yen is the standout, Matt. The yen headed for its best 3 days against the U.S. dollar, going all the way back to March of 2020, which of course was the height of the fear around the pandemic. The dollar yen right now trading right around 133. That is the strongest Japanese yen we have seen since mid-June.
Yeah, very serious strength there. Very surprising. Let's take a look at what's going on in S&P futures. This is not a surprise, up about 0.6% after some really strong earnings. Although, is good news really still good news? Take a look at what's going on in the 10-year yield. Investors are selling the bonds, pushing the yield up, but still at a relatively low level. 270.48 is the level we're looking at on the 10-year. NYMEX crude gaining a couple of dollars a barrel, up to 98.35. I guess the strength in the economy is giving people confidence that drivers will continue to put the miles down. And Bitcoin right now off about 0.5%, but it's at a relatively high level, almost $24,000 a piece. So while normally it would be correlated to futures, or really more likely NASDAQ futures, it looks like it's going the other way, at least since 5 o'clock last night. And Anna, what do you see in terms of the euro area response to the strong GDP numbers?
Yeah, really interesting to see that we had running into the GDP numbers that I'll get to in a second. We had strength across Europe, and we continue to see that. You can see on the map we've got a strong earnings picture coming through from European corporates, and that seems to be the driver today. There is perhaps also a little bit of focus, as you say, Matt, on this GDP number. So we've got euro area GDP coming in plus 0.7% in the second quarter. The median estimate have been an increase of just 0.2%. So just as we'd seen in the component parts of this number coming through from France and Italy and from Spain, actually unexpected strength supported in places by tourism, but unexpected strength in the European growth story. What is a bit more worrying, though, is, of course, what happens into the winter and also what's going on inflation. So the euro area July consumer prices rising by 8.9% year on year. That is another new high on inflation. The estimate was for an increase of 8.7%. We've seen country after country coming forward with new highs on inflation. And so those two narratives running in parallel as we consider where we go next on the Eurozone economy, essentially. Let's show you what's driving the session today, though, because if it isn't fears about growth, it is excitement around growth numbers coming through from certain corporates. We've got Brent crude up by 1.9%. Matt, you mentioned the broad risk-on appetite driving the oil price higher today. NatWest Group up by 7%. The company, this bank in the UK, beating estimates and, in fact, actually reducing the amount of money they're putting aside for bad debts. And the market have been expecting them to increase charges on that front. So that was interesting. A more optimistic picture being painted about the UK economy. Renault up by 3.4%. Yes, if you look backwards, there were difficulties and costs associated with pulling out of Russia, but the guidance they gave did please the market. And L'Oreal, this is a beauty products company, of course, based in France. I just spoke to the CEO of L'Oreal. The company up by 2.9% today. It seems that move more and more towards luxury has been helping the business, but also the breadth geographically and in terms of product also driving this business higher. And apparently they do 60%, Kailey, of their sales in China online, and that has been something that helps during a lockdown.
I guess that makes sense when people can't necessarily go outside. And of course, we'll be speaking with the CEO of Renault later on this hour. As for what is ahead later on today, U.S. House Speaker Nancy Pelosi will be leaving for her trip to the Asia-Pacific region. We know where she is going. The question mark is, will she also go to Taiwan? The big oil companies report their earnings results, with ExxonMobil and Chevron both reporting before the bell. And we'll get some very important U.S. economic data, including personal income and spending, PCE, and that employment cost index that Jerome Powell talked about on Wednesday, Anna.
Let's get back to some of those tech themes then, Kailey. Apple's third quarter revenue and profit narrowly topped estimates, with iPhone sales holding up better than expected. Speaking about Apple's long game, CEO Tim Cook told Bloomberg, quote, "We believe in investing through downturns. We've always done that and have found that made us stronger on the other side. That's the frame of mind we go into." Meanwhile, Amazon showed its e-commerce and cloud computing businesses can churn out revenue even as consumers worry about inflation and the company gets serious about curtailing expenses. Matt Bloxham, Bloomberg intelligence analyst, joins us now. Let's begin then, Matt, with Amazon, because this is the one that pre-market is seen, most on the move. Excitement where here? Around the revenue or about costs?
I'd say both, but probably more so on the cost side. Obviously, they've faced quite big headwinds to profits on the e-commerce side through the pandemic because they've built up such excess capacity and fulfillment. And they've started to bring that under control. So in the quarter, those costs were lower than expected, and they gave quite a strong message that they'll continue to focus on that going forward. They're going to invest incrementally in the cloud business going forward. That grew 33% in the quarter, so clearly still seeing a lot of opportunity for growth there too.
Apple also had results that pleased analysts, but Tim Cook listed off a number of headwinds for the company.
Yeah, he did. It's a challenging time for all tech companies. I think obviously supply chain issues are still a problem for them in terms of meeting demand. But I think they were showing some signs of optimism that those issues are starting to kind of fade a bit. So as they go through their next product upgrade cycle, expecting a new iPhone 14 to be announced in September, that maybe that will kind of they'll be able to sell more of that, and the supply chain issues won't hold back the potential there.
Okay, Matt, thanks very much. Matt Bloxham of Bloomberg Intelligence. Thanks for joining us. More on tech ahead. We will speak to the investor Mark Stokel of Adams Funds. His top holdings include Apple and Amazon, so plenty of analysis on the tech front. Let's get back to the data that just broke at the top of the hour around the Eurozone economy. We've been gradually building up a picture of strengths and weaknesses today. So on the GDP side, the quarter-on-quarter number for the second quarter up by 0.7%. That really much higher than the estimate. So GDP running much higher than was anticipated. Questions about the future, of course. The CPI numbers, the numbers there coming in higher than estimates as well, and that more worrying, of course. 8.9% is the inflation rate now for the Eurozone. It was expected to be 8.7. Joining us now with analysis, Marcus Ashworth, a Bloomberg opinion columnist. I guess we should reflect on the strength that we've seen in these growth numbers, some of it from tourism, Marcus, that sort of revenge tourism showing up here, but real strength in particular coming through in some places, Spain and in Italy.
Yeah, it's very much the southern part of the tourism strength, clearly, as you said, revenge holidays indeed. I could hear them this morning. The planes going over my house have definitely increased. But, for sure, there's also not just tourism, but it's just opening up the economy. That trend is quite strong from the pandemic, finally been over. There's a lot more activity going on. The outlier here, unfortunately, is Germany at flat, and I think that's something to keep a very close eye on. But let's celebrate for once a decent, much stronger quarter. How much of that goes through into the back end of the year and indeed into the winter is very much dependent, as always, as with inflation. As you can see, the numbers ticked up a bit there, 8.9. I don't read too much into that. I mean, Italy fell, for instance, so it's just bumping around. It's very difficult to get a clear-eyed read on inflation, other than the fact, as with growth, we're in the hands of what happens with the gas supplies over the winter coming from Russia.
So Marcus, does anything in this data change the calculus for the ECB?
Well, that's a good question. I haven't really thought about it that way. Not really. I mean, I think they'll take some semblance of hope, the fact that they did the 50 basis points and they've not walked straight into a horrible GDP number. So they'll be relieved that they've been able to do a sort of bold move, and it hasn't looked instantly terrible. Not to say it won't look a little bit scarier, perhaps later in the year. But I think it does put the focus, therefore, back onto September and whether they do 25 or 50. And you could think certainly the argument to do another 50, if that's what they chose to do following the Fed, they could do that with a bit more confidence now.
They can run free, Marcus. They can run free on the beach of life because of this growth. Marcus Ashworth there, Bloomberg Opinion, thanks so much for joining us. Now, yesterday's GDP report for the U.S. showed a shrinking economy. On the back of that data, Treasury Secretary Janet Yellen held a press conference almost as if she had seen it beforehand. She spoke about the slowing U.S. growth.
We do see significant slowdown in growth. That's to be expected given how rapidly the economy grew when it was recovering from the pandemic and all of those job losses, and policy was designed to do that. We should expect to see a slowdown. This economy is at full employment.
U.S. Treasury Secretary Janet Yellen. So Kriti Gupta here on set with us. The administration is assuring us this is not a recession. Two quarters of contraction does not mean a recession all of a sudden. But the bond market seems to be down with that.
Yeah, it creates a really big bull case for treasuries, which is, by the way, the exact opposite of what we've seen in the last year or so. It's not just treasuries, it's bonds around the world, really. And you're seeing that in the complete transition from the inflation narrative to the recession narrative. To our radio audience, basically, you're looking at a chart here that is looking at global bond yields, and it's basically skyrocketing, a pretty steep decline, or incline, I should say, going to about 1 or 2 months ago, where you see a complete turnaround. And that turnaround, once again, it does create that bond bull case. And I think it's really important when we talk about where we're investing our money, because when you start to see this turnaround in the stock market, you tend to see an opposite reaction in the bond market as well. Right now, to see both stocks and bonds bid, I think that's pretty new.
Yeah, both global bonds and the S&P 500 heading for their best month since November of 2020. So it goes to show you how bad news seems to be bad news for the economy, but not necessarily for the stock market. Right. And of course, while we're speaking of the economy, we're going to get even more economic data at 8:30 a.m. Eastern. Spending, income, PCE, ECI. Which do you think is going to be the biggest catalyst for this market?
It's definitely going to be the employment cost index right off the bat, because there's Chairman Powell named it on Wednesday. He was very vocal about it. And remember, he's been very vocal about just how tight the labor market is. It begs the question, how much unemployment do we actually have to see for the Federal Reserve to be comfortable with this labor market, which once again is a pivot from what we heard pre-pandemic, where they were so proud of how strong the labor market is. Compare that to the Biden administration. You heard it from Janet Yellen, you heard it from President Biden yesterday, that a strong labor market is actually a very good signal. Remember, we also get the PCE data as well, which will complement the CPI numbers. But really, at the end of the day, it's the labor market that isn't being included in those headline numbers. So that's why the employment cost index is going to be potentially a market mover.
Kriti, thanks so much. Bloomberg's Kriti Gupta with the latest on the U.S. economy. Sticking stateside, House Speaker Nancy Pelosi is set to depart for Asia, but it's still unclear if one of her stops will include Taiwan. This comes as President Biden and China's Xi Jinping plan to hold an in-person meeting. Emily Wilkins, Bloomberg government reporter, joins us now. What's the aftermath of that call and the setup to this visit to Asia?
So Speaker Pelosi's office still has not confirmed that she will be visiting Taiwan, but we do know that the Pentagon is preparing for that potential trip, trying to figure out what the contingency plans need to be here. Obviously, an historic trip, first time for a speaker to visit the island in 25 years, but also coming at a time where Biden and President Xi are really trying to manage that relationship. You did see that 2-hour call between both leaders yesterday. The White House said that Biden and Xi are now going to try to get together for an in-person meeting, the first since Biden has become president. But Xi also had a warning for Biden. He said to not play with fire, seemingly referring to that trip that Speaker Pelosi is potentially leaving on today. She'll also be going to other areas in the Asia-Pacific region, including Japan and Indonesia.
All right, so that's on the foreign policy front. On the domestic policy front, of course, we had news earlier this week on the agreement reached between Joe Manchin and Chuck Schumer. Where do we go on reconciliation from here?
So we always talk about President Joe Manchin, but it's worth noting that any of the 50 senators are really important here. And right now, all eyes are on Senator Kyrsten Sinema. She's a senator from Arizona. She's raised concerns about tax provisions in the past, particularly that carried interest. She does not want to see that in the legislation. It is currently in there, expected to raise $14 billion over the next 10 years. Senator Joe Manchin says it needs to be in there. Everyone's waiting for Senator Sinema to say whether or not she will support it. If she doesn't, that's it. Game over, unless they can figure out some way to work around it. Right now, though, the current delay would be with the Senate parliamentarian. Remember, not everything can go in this reconciliation package. So you have to have the parliamentarian comb through the language, give it a yay or nay, and that might wind up taking a couple weeks. One thing that we know is that lawmakers in the Senate, they're certainly expecting to be here next week, potentially even into next weekend, and House members are on alert that they could get a call within 3 days to come back to D.C. and vote on that package.
All right, Bloomberg Government's Emily Wilkins reporting from D.C. for us this morning. Thank you so much. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. One of the big movers to the downside is Intel. After it cut both its revenue and profit forecast, the company's struggling with a softer environment and market share losses. The CEO, Pat Gelsinger, talking about how they just need more time to get competitive. That stock is down 9% before the bell. It's an even bigger move lower, though, for Roku. This, of course, is the TV streaming company, and perhaps no surprise, given what we've heard from the likes of Meta and Snap over the last week. They say advertisers are pulling back on spending, and that is going to weigh heavily on them in particular. That stock down 26% before the bell. But of course, the more positive stories out there include Apple and Amazon, which we were just talking to Matt Bloxham about, and those together represent about 10% of the S&P 500, even more of the NASDAQ 100. And as a result, QQQ, that ETF that tracks the NASDAQ 100, is higher by about 1% before the bell, Anna.
Lots to focus on at pre-market then. Coming up on the programme, we will speak to Renault CEO Luca De Maio. We'll discuss the automaker's latest results. What are the challenges they are facing right now? We'll get to that conversation shortly. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. Now, Renault raised its outlook for the year as it sought to draw a line under a costly withdrawal from Russia that led to a first-half loss. Russia was Renault's second biggest market before the pullout. Joining us to talk about the results and the future is Luca De Maio, Renault CEO. And Luca, thanks so much for coming on the program. Let me ask first about the margins, because I saw 4.7% and you're looking to get to 5%. Now, from a U.S. perspective, I have to wonder, have you thought about making pickup trucks because they have much bigger margins?
Yeah, I mean, of course, you know, you have markets like U.S. that are very rich. We have never been able to, you know, penetrate this very important market, or markets like China. But I think in the European context, for a volume brand, is already a decent performance. It's probably one of the best performance we did in the last 10 years, both in terms of cash and margins and unit margins. And we are looking at, you know, developing the business because I think we still have a lot of, you know, to improve compared to some of the best competitors. But we are optimistic. We did a lot of work in the last couple of years.
What about the U.S. market? I mean, my first car was actually a Renault GTA convertible, fantastic machine. But we really haven't seen the brand in this country since then. Are you ever coming back? Could you partner up with someone else to bring cars back to the U.S.?
But it's in our wildest dreams, but so far we don't have a concrete plan. But especially with some products and some brands like the sportier brand like Alpine, it's potentially a market that could you know, be interesting, and where, you know, American consumer might be interested in our offers. But we're now concentrating on Europe, because we have to catch back, you know, market share and get back to our historical position, and so that's the focus of our activity in the next months. But you know, why not? You never have to close, you know, the door to dreams.
Okay, yeah, keeping Matt's dreams alive. Anyway, Luca, good morning. Let me ask you about the chip story. We spoke to Carlos Tavares yesterday at Stellantis, who said he expects the chip supply issues to be resolved by the end of 2023, so still more than a year off. What's your time horizon? How do things look to you?
I don't think we have full transparency. I think there's scarcity of semiconductors. It's becoming, at least for our industry, relatively structural until we get into new generation of products on our side. But the situation is getting much, I would say, better. We don't have the full transparency and stability we had, a couple of years ago. But when I see May, June. We were supplied, and when I look at now to the end of the year, we have, we are confident that we can, do the year properly, although it's a very complicated supply chain, like on many other, components.
Yes. Luca, I wonder how resilient you see consumers as being as we face lots of questions, certainly in Europe, going into the winter. What we're seeing from other consumer-facing businesses in other sectors is the luxury end seems to be holding up well. The challenges seem to be at the lower income consumer end. How do you think that will play out for Renault?
I mean, we have, we actually have three brands in the house. One is Alpine. Is the sporty, more premium brand. Then we have Renault is the core of our business. And then we have a brand called Dacia that is offering, value for money products. And it's really, a brand that is very adapted to the times. So we are seeing growth on both, on the three brands actually. But Dacia is somehow our life insurance to this kind of, potential demix. But I have to say that Renault, because of the new product coming in, will show a growth very, 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 very soon. Not only on the financial dimension, but also in the volumes in the next month. So I think we might be anti-cyclical because we will benefit of a very positive life cycle from now to 2025.
All right, Luca, speaking of your plans, you are planning to transform Renault and carve out EV and fossil fuel businesses. I know those plans are still in the works, but you've said it could include partners. Who are you talking to?
Now, we're talking to a lot of people, and we are looking at people not only on the automotive industry, but also from the tech industry, because we believe into such kind of horizontal partnership, horizontal to the sectors. So some of the challenges that we have in digitalization or energy transition are issues that cut industry horizontally. So I don't think we only have to look into our sector, but a little bit everywhere. And it's very exciting, actually. Hundreds of people are working on those projects. We don't only have the idea of, kind of separating a pure EV next generation OEM. We have other ideas, but we're going to talk about that in the fall.
What role will Nissan play?
We've been very transparent to our partners, so they know that we have to do it. That they know that we will do it, and we have opened the door to them for each one of the projects. But at the end, it's their decision if they want to jump on the boat. But the train is leaving the station. So
how is your relationship then with Nissan right now?
Very good. I have a very good relation with the management of Nissan and Mitsubishi. We're doing a lot of things. You will see very, very soon that we're taking the topic from the bottom. That means from concrete industrial projects. We already made a couple of decisions that are visible, like the cooperation with Mitsubishi on the lineup in Europe, or the fact that Nissan will be building successor of a small car in our plant on our platform. These are very, very concrete and symbolic signs that the alliance is getting into a new chapter, and that we are creating together a new dynamic based on fairness, respect, and win-win mindset, I would say. So I'm very happy. Very happy about that.
All right, Luca, thanks so much for joining us. Really appreciate your time today. Luca De Meo there is the CEO of Renault, talking about the company's results. So, Kailey, it looks like margins are improving, and the dream of coming to America, the door is still open to that.
Yeah, very inspirational. And speaking of margins, they held up pretty well for the likes of Apple as well. Both Apple and Amazon beating expectations after the bell. We're going to talk to a shareholder, Mark Stokel of Adams Funds, will be joining us next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Traders focus on recession instead of inflation. That's led global bonds to their biggest monthly gain since 2020. Today, investors are waiting for more data on the Fed's preferred inflation gauge, PCE deflator, U.S. personal income, and consumer sentiment. Big tech comes to the rescue. Amazon and Apple surprise Wall Street with quarterly sales results. We'll get analysis on that shortly. And Joe Biden and Xi Jinping now plan to meet in person, but the question of whether House Speaker Nancy Pelosi will visit Taiwan could complicate matters. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, lots of earnings stories, moving markets around here in Europe. The data also of interest, but tech earnings, I suppose, that have been through the overnight session, I guess, for you guys, have been propelling NASDAQ futures.
Yeah, that's right. You had surprise positive GDP. Meanwhile, here in the U.S., GDP contracted by almost 1 full percent. Nonetheless, earnings have surprised to the upside. And as a result, we have futures that are rising again after a couple of days of really strong gains. So S&P futures up 0.7%. We could see S&P 4100 today. The 10-year yield coming back up as investors sell some of those bonds that they bought to guard against the possibility of a recession. Right now, the level 2 spot 7066. And as concerns about a recession are maybe allayed a bit, certainly in Europe, not as much here in the U.S., we have crude coming up, $2.20. This is for Texas Intermediate to 98.62. But of course, Brent is rising as well. Finally, Bitcoin not doing a lot, but hovering around a relatively high level of almost $24,000. So Bitcoin has had a good run with other risk assets. Of course, they're very positively correlated. Kailey, what do you see in terms of pre-market movers?
Well, as you and Anna were saying, it really is all driven by two companies in particular, Apple and Amazon, because they're 10% of the S&P 500. They're almost 20% of the NASDAQ 100. So the fact that they are moving higher after the results really is what is leading the broader market here. Amazon is flying up more than 12% after it beat on expectations and gave a stronger revenue forecast than expected. AWS still doing well. And maybe that slowdown in consumer spending we were all worried about isn't hitting them too hard yet. But that big jump shows you how the bar was relatively low going into the quarter. Apple also higher by the better part of 3%, working through China's supply chain issues. The iPhone is still doing well, even as Tim Cook still recognized those macro headwinds, but it's getting a lift. Intel, though, a very different story, giving a disappointing outlook, cutting its profit and revenue forecast. It's dealing with competition as well as that economic slowdown. It's down 9%. And because of that economic slowdown, advertisers are spending less. We've heard that from Meta, we've heard that from Snap and Twitter, and we heard it from Roku last night, which is the TV streaming company. It is down 25% after its revenue forecast disappointed, Anna.
Kailey, let's have a look at how we're doing here in Europe. And stocks are higher here in Europe. It's pretty broad-based across the European space, but in particular, the periphery doing pretty well. We saw that actually reflected in the GDP beats. They came through most strongly in Italy and in Spain. A less positive story in Germany, but it's also the earnings news that's pushing markets around today. Brent crude, just like Matt talked about with the WTI price, moving higher today, up by more than 2%. But onto the earnings stories, we've got NatWest, the banking group here in the UK, actually releasing some of the reserves it had for bad debts, and the market had been expecting those to build a little. So that's a better sign on the UK economy from NatWest. Renault, we spoke to the boss just a moment ago. That stock up by 3.6%. Yes, they took that took a hit really with regards to pulling out of the Russian business, but there was some guidance that was more positive, and the stock moving higher on that. L'Oreal up by 2.8%. This business, the CEO told me, Kailey, protected by its geographical spread when times got tough over in China, but also in the makeup of its products from the lower end for consumers at that end of the market, but also up to the luxury end, and it's that breadth that seems to be supporting the business at this time.
All right, Anna, well, let's bring it back to the U.S. earnings story, because Amazon and Apple are set to add almost $230 billion in market value after joining Alphabet and Microsoft in assuaging concerns with higher revenue. Joining us now is Mark Stokel, CEO of Adams Funds. Mark's top holdings include Apple and Amazon, as well as Alphabet, Meta, and Microsoft. So basically all of the large cap technology stocks. Mark is up early for us on the East Coast. So Mark, obviously, you have positions in these companies. Judging by the market reaction, investors are relieved. How confident are you feeling, given that the beats weren't that large?
Well, yeah, it's a really good question. I think that the setup. I mean, everybody was scared to death coming into this week. You heard it everywhere, and the expectations certainly were lowered, I think. But looking at companies like Amazon, exceeded, even lowered expectations, but really good quarter. and Apple was really really very good. So, I think we need to take into consideration the fact that all of these companies are working in an economic environment that is very difficult. And I think in a very difficult environment, I think tech earnings this week ended up much better than most people expected.
Well, to the point on the environment being difficult, in theory, as central banks continue to tighten, the environment could get even more difficult. So as Tim Cook doesn't give any, or Apple doesn't get any firm guidance, and Tim Cook talks about these macro headwinds, are you worried that even if they held it together in this past quarter, it's going to get worse as we move through the year and into 2023?
Well, I think you have to consider that. There's no question about that. To think that this quarter is the all clear from how the macro headwinds are going, if we continue to have headwinds, how they're going to affect these companies would be silly. So I do think you need to consider that. On the other side of that, I think you have to understand, or at least acknowledge the fact that Tim Cook and Apple have managed this better than probably any other company. So are there likely going to be some more headwinds? Likely, yes. And as a matter of fact, even Amazon talked about feeling their expectation that there would be a little bit more on the inflation front for them in the third quarter. So I think you have to do that. I also have to think you have to expect that in addition to the fact that these companies could likely have some more headwinds, they're really operating very, very well. And if you want to be invested, what is your alternative? I would say that investors should be invested in stocks like this for tough times. You see a Roku and what happened to them. You see Walmart, what happened to them from execution. Because of that, there were a lot of expectations that these companies were going to deliver, and they did. But you do have to be somewhat concerned about what's coming up in the next quarter, certainly for the balance of this year.
Mark, how do you feel about valuations? Right now, I think Apple has a forward PE of 25 and change. Does that seem attractive to you?
From a valuation standpoint, no. But I would also tell you and your viewers that valuation isn't always a good indicator of whether a stock is going to outperform or not. What is a really good indicator, frankly, is what Apple did this quarter. The fact that they delivered really good results. Is it expensive? Yes. I don't think there's any way, Matt, that you could say it's not expensive. So I think you need to balance a very good company delivering really good results with a higher valuation. I would put my money, until proven otherwise, I would put my money on Tim Cook before I would at Roku or some of these other companies that really haven't delivered very well from an operating basis.
Is there anything out there, though, Mark, that you feel is cheap right now? For bargain hunters looking for value, where would you recommend?
Well, I will tell you, the intoxicating part of Meta is the fact that it's cheap. It's a really hard one, I think. There are a lot of things that are very attractive about Meta. My fear is maybe with biggest is the fact that it's really cheap. They're going through a change. I mean, until last quarter, Meta had a halo over them. Of course, they disappointed in a very big way. But there are a lot of moving parts going on in Meta. I think for someone who has a longer time horizon, has a couple-year time horizon, could Meta be a good opportunity? Yeah, it could, because it is cheap. But I'm afraid for the next couple of quarters, it may likely be cheap for a good reason.
Okay, and there's a lot of change in management coming as well, Mark. Let me ask you about Amazon in a bit more detail. Advertising, something that, unlike for some tech names, advertising seemingly doing pretty well for Amazon. I read one Bloomberg opinion piece today saying we need more clarity on what exactly is driving that advertising number. Was that one area of strength for you?
It was a very big. Not only was it an area of strength, as you noted, it really flies in the face of what Walmart, what Meta, what Google, what Target, all of these other companies talked about, certainly for the consumer, but also for advertising. Really really amazing from an advertising revenue perspective. So, but we do need to get that. They did not give us very much. I talked to Dave Schimminger, our discretionary analyst, about this for Amazon, and we really don't know exactly why it is. I mean, one of the things that they talk about is as customers are going through, as the consumer is going through Amazon and they're seeing their ads, they actually do have their credit cards out, and actually finishing that sale is a little easier for them than putting it on Instagram or putting it on Facebook and then hoping that the consumer moves to to buy something that they've looked at. So they're a little closer to the consumer from that perspective, but we really do need to get more input, because it just flies in the face of everything that everybody else reported.
Okay, thanks so much, Mark. Really good to speak to you. Adams Fund's Mark Stokel with us to analyse the tech sector. Coming up later, we'll go from tech to oil. Amrita Sen joins us, Director of Research at Energy Aspects. Oil prices back to their gaining ways this morning. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Intel CEO Pat Gelsinger. That's at 11:30 a.m. New York time, 4:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Well, let's take a look at oil, because it's heading for its first weekly gain in 4 weeks, despite concerns of an economic slowdown. WTI prices up 2.3% this morning to over $98 a barrel, $98.67, where we trade at the moment. Amrita Sen, Director of Research at Energy Aspects, joins us now. Amrita, I've got to be honest, a day after we saw a second consecutive quarter of negative GDP prints here in the U.S., I wouldn't necessarily expect oil to be doing this well. What does the economic slowdown ultimately mean for the balance of demand and supply?
So I think there's a couple of things, right? There is what we would call a technical recession, which is what the U.S. is in right now with the second quarter GDP numbers that have come out. But in terms of oil demand, I mean, employment matters a lot more, and we are really not seeing the kind of oil demand declines that you would expect from a kind of deep recessionary environment. So I do think it's important to put the GDP declines in context for the oil market. I think that's the first thing. The second thing is that there still is a lot of pent-up savings and demand due to COVID. And we've talked about this before as well. Asia in particular still seeing very, very strong demand growth numbers out of there. So overall, I mean, we have already factored in some really steep declines in our European demand numbers and US demand numbers from Q4 onwards this year. But if anything, there's potential gas to oil switching because of very high gas prices that can actually lift demand higher. But even with the kind of European and US demand declines, we still have global demand growth at 900,000 barrels per day year on year next year.
So would you say then, for those who are not so focused on just the energy markets, Amrita, would you say that maybe more broadly in the market, recession fears seem a little overdone, given what you're seeing in the oil space?
Yes, I really think it will matter from sector to sector, right? And employment, and given how tight the labor market is right now, if employment is the biggest driver of oil demand, given its kind of link to transportation, that's the key factor and the key variable that markets really need to look at. Of course, is the economy slowing down? 100%, 1,000%, I would agree with that. But it doesn't mean that we are going into an 08-09 style recession. I do find, talking to traders in the market, they always tend to compare, there's an upcoming recession, it must be like 08-09. 08-09 was a credit crisis. It was very, very different. This is much more the usual, recession like we've seen in 2001 or in the early 90s. In those periods, oil demand has still continued to grow.
Okay, and so that's the demand side. Let's get to supply, I suppose. Amrita, what do you see being the next driver on the supply front? I know we've got meetings taking place next week.
Yeah, I mean, look, OPEC Plus are meeting on the 3rd of August. We are expecting a very small increase from the group, continuing with what they have done. Now, of course, technically speaking, they have already unwound all their cuts from April 2020, May 2020, I should say. But they are going to continue to add a little bit, given how tight the market is. The reality is very few of these countries even have spare capacity, right? So even if the headline number is we're going to add 400,000 across the group, the actual volume coming out to the market is half of that, right? So it is something where this is structurally a bullish market, where unless and until demand actually declines outright, there just isn't enough supply. I mean, July high-frequency data is showing declines in inventory of over 2 million barrels per day. That's with SPR still coming out of both US and Europe. So imagine when the SPR stops at the end of October. I think that's the thing the market is completely missing right now.
How about spare capacity in the U.S. and Canada? How much spare capacity is there in the Gulf and in the shales, Amrita?
Well, there isn't spare capacity in the same way as OPEC, right? OPEC chooses to hold spare capacity, which is always very expensive to maintain. And again, the market needs to give them credit for doing that, because that's why, or that's how they try to prevent a lot of volatility in the market. US producers are pumping as much as they can. The biggest issue with US producers is the lack of labor, lack of equipment, steel shortages, and of course there is capital discipline, right? But that's just this new structure of US shale. Similarly in Canada, but the real shortages in oilfield services is something to watch out for. We are expecting US production growth to pick up from August. So far, we haven't seen the kind of pickup we needed to see in the rig counts or the well completions to be confident that our forecasts are going to come true.
How would you expect the oil market to react to Russia pulling out of Ukraine, or some sort of culmination of that war? What would the oil market do?
Headline, if, and we are absolutely not expecting this, but if there were to be an end to the war, first and foremost, doesn't mean sanctions will get lifted anytime soon. So it really depends on how sanctions move after that. But keeping all of that aside, I really, really want to stress on the fact we were at $95 oil prices before the invasion. We've called for $100 oil prices from 23 onwards. Well before. This was back in 2018, and we had expected Russia to continue growing. Russia is not the reason we are here today.
Amrita, thanks so much. Thanks for joining us. Amrita Sen of Energy Aspects, taking a look at oil markets. And stay with Bloomberg for coverage of Exxon and Chevron's earnings. They are due before the US Open. We'll bring you the latest news analysis and market reaction. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now, a strong quarter from Standard Chartered's traders provided a boost to the emerging market-focused bank. That's despite fears that a slowing global economy could squeeze its lending business. CEO Bill Winters spoke to Bloomberg earlier today.
I think the inflation problem we've got is quite substantial and reasonably intractable. So I think the Fed's going to have to hit pretty hard. So I guess that means a terminal rate at 3.5 or maybe even 3 3/4 or 4%. Is that what it takes to tip the U.S. into recession? Yeah, I think so, speaking candidly. But we hope for the best. And I think Europe obviously has the incremental burden of energy prices, and that's tough. The good news is China is probably still going to produce 4% plus growth this year, and then better into next year. The inflation problem is a little bit less acute in Asia. Those trade flows within the Asian region are very strong. And we think that Asia could be a little bit of an engine to pull the global economy back from the edge while the US and Europe are going through their cyclical downturn.
With that in mind, to deliver that engine of growth, do you see a much more significant policy divergence, Bill, between PBOC to Fed to ECB? Is that what stokes that engine?
No, I think what's stoking the engine is that Asia has been suppressed by COVID in a way that the West has not been for the past year or so. And Asia is coming out of that period of repression. And that so yeah, of course there will be interest rate policies that will be reflective of the domestic economic situation and the domestic inflation outlook. And as we sit here today, the growth outlook in Asia is on a cyclical upswing, together with inflation, which is relatively contained. Now, that's not to say that an inflation in the West won't impact Asia. Of course it will. It will impact trade flows. It will impact FDI. And to the extent that the U.S. has to hike rates materially, it will keep the U.S. dollar strong. But on balance, we see a bit of asynchronization between the West and the East, which has two effects. One is it should help smooth through this economic cycle, at least on the margin. And two, it's pretty good for Standard Chartered Bank.
That was the CEO of Standard Chartered, Bill Winters, speaking to Bloomberg earlier. Now, speaking of earnings, we've had some really positive surprises, but I think, Anna, the surprise is just that there was a surprise. It's not beating by that much. In fact, if you take a look at EA Go, you can see a whole slew of earnings data, and you'll notice the chart in the lower left-hand corner. For those of you on radio, I'll describe it for you. It shows blue columns that represent the amount of surprise, the amount of the beat that earnings have seen over the previous quarters, and it just comes down to almost zero. For example, in technology, we've seen only a 0.02% beat on sales and only a 1.01% beat on earnings. So the surprise is that we didn't get analyst cuts as much into earnings and that the companies still overachieved, but they aren't really beating by that much.
Yeah, it's interesting. And also, I was just looking at what you were showing there. I wonder if you strip out energy, and certainly this applies to the European case. If you strip out energy, does that make things look a little bit worse? It's interesting looking at the European side. I pulled up on my screen, and I can see that the sales beat was bigger than in the US, but the earnings surprise is not as good as the sales surprise. And so that chimes in with what Bloomberg Intelligence was saying, that often businesses here in Europe manage to beat on sales, but then the costs are kind of getting in the way of them beating on the bottom line as well.
Yeah, and of course, we've seen a real difference in the GDP stories as well. Just at the top of our show, European GDP broke much higher than had been anticipated, and most countries beat, although Germany didn't. But still, it's positive, whereas here, we're looking at a contraction.
Yeah, absolutely. A contraction in the US for the second quarter, beating on growth in the Eurozone. What happens next quarter, though, I suppose, is still the question. Inflation at new highs in the Eurozone. This is Bloomberg.